The information in this recording is general in nature and should not be considered personal advice. Please consult a professional and qualified financial advisor to discuss how this information may apply to your personal circumstances. Thanks for listening. Hello, welcome everyone to our second annual State of the Markets event. So the theme for this year being how to prepare for the end of the cycle. Thanks all for those joining. I know many of you are clients, and for those that are new, we appreciate you making both of you making the time. My name's Dane Pimble, and I am a licensed financial advisor, and I lead Life First Advice's asset allocation solutions. And joining me today is my colleague and fellow financial advisor, Adil Abbas. So just a little bit of a housekeeping before we begin. We like to keep these sessions interactive, so if you do have questions, by all means, please jump off mute and ask them. There will be a time for questions, or you can pop them in the chat as well. We'd also like you to turn on your camera if you haven't. It just helps make it a lot more of a human experience, particularly for the presenters. And just before we get started, obviously what we're talking about today is general advice only. If you do wish to act upon anything that you hear about today, we strongly recommend that you seek advice, ideally, hopefully us, but if not us, at the very least, a qualified professional prior to making any decisions based on what you learn today. And so if this is the first time you're joining one of our workshops, then just a little bit about us first. So at Life First Advice, we've got one very simple philosophy when it comes to money, and that is that life is more than money. Money simply being the tool that enables you to live your best life. And it's our mission that in all of the advice that we provide you is that we aim to align your money decisions with your key life decisions to help lead your best life. And the basis behind that advice approach is centered on Dr. Margaret Swarbrick's research on the 8 dimensions of well-being. And so we believe that the overall well-being is a healthy approach to living. And it could mean doing things like purposeful work, enjoying good relationships, eating well, having a work-life balance, whatever that is, and of course, financial well-being. So our focus today is certainly going to be on the financial well-being pillar. And we're very lucky to be joined by a leading global expert to share their insights with us. So today, it's my absolute privilege to introduce world-renowned economist Akhil Patel. Akhil is Director of Property Share Market Economics and author of The Secret Wealth Advantage, How You Can Profit from the Economy's Hidden Cycle. Akhil's been working with fellow economist and business partner Philip J. Anderson for over a decade now, and they produce unique research that combines an in-depth understanding of business, real estate, and stock market cycles. Akhil has professional experience in audit, central government, and international banking, and has worked on a range of issues from reviewing large infrastructure public-private partnerships, helping establish the UK's $3 billion International Climate Fund. He has 2 master's degrees in finance and public policy and a first degree in the classics from Oxford. He's also currently a principal policy advisor to the European Bank for Reconstruction and Development. So, welcome, Akhil. Thank you very much for giving us your time.
Thank you so much for having me, Dane. Really pleased to be here.
Absolute pleasure. Just for your benefit, Akhil, I just thought I'd share with you kind of the audience. It's a little bit of a mixture of clients and friends and connections of clients. Some on here would be subscribers to your existing service. Many though on the call are either completely new to your research or have only a fleeting sort of understanding. So
Brilliant. Really pleased to meet you all.
great. So thought we could jump straight into some Q&A, Akhil.
Okay.
So when we're talking about the cycle, there's obviously many different cycles, and the term can be quite nebulous. And obviously, your work centers around an 18 to 20-year US economic cycle, and this cycle impacts investors globally. So, are you able to talk about, well, what is this cycle and why does it repeat so reliably?
Well, the 18-year cycle is, in my view, the economic cycle. It's the boom bust cycle. It's the cycle that explains all of the major booms that we see in kind of economic life and all of the major crises and crashes that kind of come at the end of the cycle. And it's been going on in the UK and the US for well over 200 years, and in other countries as they've developed and joined part of the global economic and financial and trading system. Um, and it repeats so regularly because it is essentially at its heart a property or a land cycle. And land is one of the three main factors of production. We all need a bit of land to live and work and so on. And it's a relatively scarce resource. I mean, well, sitting in Australia it probably doesn't feel that scarce given that you live in a vast you live in a vast continent. But land in good locations where people want to live and work is relatively scarce. Therefore, it makes it sort of ideal for kind of investing, but also speculation. It underpins the collateral of the banking system, and its sort of pricing and its values can go over the top. Um, that creates economic booms, but it can also, on the other side, create economic busts. So it's kind of fundamentally hardwired into our economies, which is why it repeats so regularly and for such a long history.
Fantastic. And obviously we're talking here about you characterize it as an economic cycle, but it has very significant influence and impact on both share market and property markets alike. Are you able to sort of talk through what that linkage is and how it's obviously they're very different markets and and the experience is different. Are you able to sort of talk through how the cycle influences both property and share markets alike?
Well, we'll start with property. So I said it's a land cycle. And when we talk
Mm,
about the value of property, really, we're talking about the value of the land and the value of the building. And one is effectively depreciating. I mean, not maybe not as quickly as some of the tax rules allow, but one is depreciating because, as any homeowner knows, bits fall off and need repainting and renewing and all that sort of thing. And the other thing is typically increasing. And so when people talk about rising property prices, what they're really talking about is rising land prices.
mm,
Uh, and so over the course of a cycle, you get rising land prices. It goes over the top, often associated with the amount of bank lending that's permitted against that land. And when it goes over the top and the flow of credit kind of slows down, it starts coming down again. And in some cases, particularly in areas which have seen maybe a little too much inward investment, too much speculation, it can come down quite hard. When it does that, there's a lot of increase in bad debts and so on, and that affects the amount of credit that's available for businesses, which then kind of induces an economic recession. So the link between property and the cycle is quite clear.
mm,
And so while Australia is one of the few countries that measures land prices, we typically illustrate the cycle using property prices, but it's only a proxy for the fundamental kind of driver of the cycle, which is land. Relationship to businesses, well, the stock market via businesses' balance sheets, effectively, because the market cap of the stock market is effectively the value of combined balance sheets of businesses that are listed on the stock exchange. Well, there's several different kind of linkages, but probably the primary one is, well, I say the two primary ones. Um, One is earnings, and businesses do better during economic booms, obviously, and people spend more money during economic booms. And one of the reasons that you have economic booms is all the activity that's generated by what's going on in the land market. So that's both construction, which is a large segment of the economy, but it's also employment, people feeling wealthy and having more money to spend. And that kind of feeds in on itself, and that obviously leads
mm,
to higher stock market prices. But the other channel is, of course, firms themselves are large landowners, and as their sort of assets are revalued and so on, that's reflected in a higher share price.
I just want to kind of expand on that a little bit because I've absorbed yours and Phil's research probably for over a decade now, and been to a lot of events that you've hosted. And one of the I often sort of a lot of the questions that I find get asked from the audience I would couch them all in prove to me that this thing happening right now is not going to cause this cycle to not happen again. Like, what about Trump? Or what about war? Or what about China? And you're able to sort of obviously each cycle is somewhat different, but are you able to sort of explain
Yeah.
that context as to what's actually caused, you explained what's driving it, but it's very easy to get caught up in what's the news of the moment and how this time could
Yeah.
be different.
I mean, I don't want to what's the word? Overstate the sort of cycle in the sense it doesn't explain every sort of in and out of every sort
Hmm.
of economic variable and so on. And to be frank, knowing all of that kind of stuff is pretty useless anyway in the first place, even though we sort of spend all the time sort
Hmm.
of, worrying about the next sort of CPI print and, the next unemployment sort of piece of information. I mean, obviously, unemployment
Just
matters to the
right.
person who's lost their job, but it doesn't matter to the overall economy in the sense. I mean, you have ebbs and flows in activity. That's just the natural way of things. Um, the the uh, the cycle is really the fundamental kind of force underlying the economy. Think of it as the sort of these sort of great sort of forces that sort of drive, the seas around the world and sort of create sort of kind of major movements of water and all the things that affects. That's kind of like the cycle. But on the surface, waves might be sort of doing all sorts of different things based upon various factors, local winds, local weather, um, and to a certain extent, kind of human influence as well. And they might be going in slightly different directions to the underlying forces. And they can also at different times look very different. Sometimes they're calm, sometimes they're very sort of choppy, and so on. And I mean, it's not a perfect analogy, but think of kind of surface events as a bit like that. They look very different
Hmm.
each cycle. So when the cycle kind of started, probably first, and it's sometimes hard to document it in history because you don't have perfect data and the historical record is patchy and it's only it's only good enough to the extent that the person writing about it understands
Hmm.
the kind of what to look out for, or is the sort of writer who will make observations about things that they might not think is relevant, but actually to someone coming later, they see that to be a really relevant piece of data. So you have to kind of piece it together. But we were talking about a relatively post-medieval economy um, in sort of when the cycle started in the sort of 18th century, 19th century. We're now talking a highly sophisticated, advanced technological economy. Underlying forces are the same, but we look very different.
Hmm.
Um, but the reality is that people respond to economic incentives. A lot of the economic incentives are driven by these underlying forces. Human beings are, relatively predictable in their behavior.
Hmm.
Um, and, I mean, you said it yourself at the start of the meeting. We have relatively stable and universal needs. They
Yes.
might evolve over time, but the domains of those needs are actually very stable and probably relatively universal. Some cultures might emphasize certain things more than others, but they're relatable. Um, and so we respond to things in the same way. The incentives are relatively stable over time. And in the sort of current environment of whenever you happen to be kind of looking at these things, you're some people are putting too much money into property speculation. Some people are over
Hmm.
leveraging. Some people are getting caught up in the latest sort of investment fad. You know, a few years ago it was
Let's drill into that because I think
yeah,
that we could probably do a whole workshop just on those topics alone. But in the context of present, in the context of the present, where are we at currently in the cycle? Because you talk about a number of asset classes there, and the signs of speculative further are quite apparent. Are you able to sort of talk a little bit about that?
Yeah, so it's an 18-year cycle. I think it's probably no sort of great revelation to sort of understand that the last kind of major crisis was in 2008. There's usually a period of, sorting out all of the problems of the last crisis and kind of trying to reflate the economy and stimulate and so on, get the sort of banking system sorted out. So that takes several years to sort out. And so we were beginning the current cycle around 2011, 2012. There's obviously not one day where you can say that the cycle has started, but you often look at sort of major statements or developments that might mark that. We had in late 2011 sort of very significant concern about the collapse of the euro. In 2012, we were still talking about triple dip recession. We had the LIBOR scandal. And also, we had sort of the then head of the European Central Bank, Mario Draghi, say that he was going to do whatever it takes to save the
Mm,
euro. Now, you get these sorts of major things. The market might drop, but it puts in a higher low, and that is a sign that the new cycle is starting. So, if that was the start of the current cycle, the end of the last cycle, you typically have 14 years upwards from the start, not in a straight line, of course, ebbs and flows and so on. And it's usually interrupted by a mid-cycle recession about halfway through, not exactly at 7 years, but kind of roughly around that time, as we've seen from the historical record. So if the cycle was starting in 2012, you would be on the lookout for a slowdown. Often the mid-cycle recession in the middle of this expansion is minor, it's short, it's relatively easy to get out of. You were looking for that kind of slowdown around 2019, and that was indeed when if people were paying attention for it,
mm.
you started to see the inversion of the yield curve, just a very minor signal. No one really paid attention to it. You had economic data that was slowing down. You had, at least in cities where property prices had really started rising quickly after 2012, such as London, which is where I'm based. uh, Central London didn't really do much for a couple of years. Actually, probably even from 2018, but certainly in 2019, it wasn't. The property prices certainly weren't moving up as they had the previous few years. So we had the mid-cycle recession. Then you expect uh, the reflation to be relatively quick. People will talk about COVID, but actually, the effect of COVID in net terms, just at least on the economy, was to massively reflate the economy given the size of stimulus. Obviously, it's had enormous impact on other things, working life and so on. Um, so you would then be on the lookout 7 years after kind of 2019 for the end of the 14-year upward phase. So that brings us to around 2026. And so the final few years of this decade should be part of the crisis phase.
Mm.
Now, it doesn't mean it's going to be uniquely bleak and negative for 4 years. Often there's a bit of a lag between the actual crisis and the peak of the cycle. But nonetheless,
I think that's a really important point that you make there, Akhil, for the many on this call that are already aware of your research. The most common question is, well, how are you guys managing portfolios into, from 2026 with the expected
yeah,
market peak? And to your point, the reality is it's not a straight line up to the top and a straight line down to the bottom with all markets in unison, all peaking and falling
well,
at the
exactly.
same
Yeah. If
time.
it were, then probably you
It'd
wouldn't
be
need
very easy.
your business wouldn't exist.
And the cycle wouldn't exist because everyone could see it and trade it out. And I think the other part that you talked about there with the mid cycle is, I think that's also a really key point in I guess understanding what are some of the, because it seems when you absorb the research, it seems so obvious once you understand the drivers. Why do people miss it? And to your point, when you talk about the mid cycle, if you're a property investor, in most places, obviously some elements of commercial property like office and whatnot got hit, but in the most part, you weren't really affected negatively during the mid cycle, and if anything, quite positively. It turbocharged a lot of markets at that point. And I think it's in that becomes the most recent memory people have of what the next crisis is potentially going to look like. And that's where a lot of people can get caught out, I think, is the memory of the GFC fades, and then the memory of the mid-cycle becomes what people think is what a downturn looks like. But they're very, very different things, aren't they?
They are the mid-cycle. I mean, look, we have historically had significant mid-cycle recessions. The early '80s being one of them, which I gather from the Australian experience was very significant, partly because
Mm,
commodity prices were going down and interest rates were very high. And there'd been a boom in the '70s and the '60s and so on. So things were quite elevated. So you had quite a significant mid-cycle recession, but nonetheless, in fairly short order, precipitated a really rather significant boom in the '80s. And that's certainly also the experience in the UK and in the US. The mid-cycle recession of 2001 was very short. In fact, the UK avoided a recession. I think that's probably also true in Australia. The US had 6 months, but no one talks about that now. It's kind of out of historical memory. And I think it's also true to say that the COVID recession was, in at least in economic terms, people don't really talk about the economic side of things. They obviously talk about all the other effects, change of working patterns and disruption to children's education and so on, which are clearly very significant. And from a some investment point of view, of course, if you're an owner of a lot of office assets, it's been terrible. Um, but it's probably the shortest recession in US history, 4 months.
mm,
And also, it's completely different to what people were saying in March 2020 when they were thinking it was going to be the worst economic crisis in 300 years.
mm,
The reason being is that we were not at the point in the cycle where you'd have a major collapse in land prices, and therefore the banking system is relatively robust, and you therefore have much more responsiveness to government stimulus, and they clearly overdid it. Um,
mm.
because they were so worried about what was, I mean, they shut the economy down, so you've got to do something relatively drastic, but it was clearly overdone, and had a lot of knock-on effects in terms of inflation, but had a huge knock-on effect in terms of kind of speculation in all sorts of assets. But they do, I think it's important to understand that the cycle is not the only story in town. In my view, the most important, it's the most fundamental. If you're going to understand anything about an economy, understand the cycle, but it's not the only thing in town. And there are sort of ebbs and flows in different parts of the economy. The office commercial space has been really battered for a number of years. It might be recovering in some areas now. They thought retail was going to collapse. Actually, that recovered. But then sort of commercial space for data centers and logistics went absolutely bananas
Mm.
after 2020. Um, Commodities went high, then they sort of came down. They're going again, joined by gold, and silver in a really major way. Industrial metals took a while to wake up, but they've, particularly copper has been going.
Copper
So
starting to move, yeah.
there's
Mm,
different sort of there's kind of more localized supply and demand factors, and that's where the work that you do is designed to help people kind of navigate some of those variables, and it's very important. And ultimately, that's what's going to drive how much wealth your portfolio generates. It's kind of understanding the kind of underlying sort of dynamics, very important. No stock portfolio gets through a major financial crisis um, in good order without doing something about it, protecting your risk and so on, or kind of holding on for quite some time. But you've got to be prepared to ride that emotionally.
yes.
Um,
I think the
but
biggest part of that emotion is back to that point that not all markets peak at the same time, and
Exactly,
being
yeah,
nimble in different asset classes along the way will be quite
exactly. You need
relevant
to you
depending
need
on
to
that.
know the
Yeah.
particular market well, and
Yeah. Which is a
and
good segue into like sticking with the property theme in that regard. When you and property share market economics in general have talked about 2026, my understanding, as in the potential for the cycle to peak. My understanding of that is that's very much predicated on the US housing market. Based
Mhm.
on that, and I was I was very sort of fascinated by some of the research that your colleague Kathy Stacey applied to the Australian property market. Based on those timings, do you have any comments on how you see the Australian property market, recognizing different capital cities are going to have quite significant differences? But do you have anything that you want to share in that regard?
In terms of Australian
In,
capital city,
in
yeah.
terms of the potential timing of
Oh, I see.
these markets and how
Yeah.
that may or may not
Sorry.
link with the
Yeah.
US.
Well, I can probably only offer something relatively generic. I'm not, unfortunately, I'm sorry to say, an expert in the various sort of regional markets in
Mm,
Australia. Um, but typically, the US leads the rest of the world into and out of every cycle. It may change.
mm.
Maybe when China is the world's largest economy, maybe something will change. But nonetheless, that's the sort of
Yeah.
historical record, and that's what we go with. And it's usually peaks around a year, maybe slightly less, maybe slightly more, a year ahead of other economies.
Mm,
So we talk about the crisis of 2008. Probably the UK um, peaked in 2007, and Europe peaked in 2007. The US, again, going back to the data kind of issue, you can't always point to a single day or whenever when the cycle
of
peaks.
course.
But
Yeah.
the US
Even at the
probably
capital
peaked
city
in
level,
late,
it's different. Yeah.
yeah, it probably peaked in late 2006. Now that's an average. Of course, in maybe in the center of New York, things weren't going up much in 2006. But on the edge of kind of Arizona and where there'd been a lot of building, maybe things went on a bit longer. Certainly, commercial real estate went on going up into 2008, even in the
Mm.
US. So there's kind of a topping process.
Yeah.
What you tend to find, just as an addendum to that, what you tend to find is that if you take any given region in the context of the cycle, you'll find that the strongest growth is in the capital or in the center of a city early in the cycle. And then as the cycle
Yeah.
progresses and as land gets more expensive, it spreads out.
So for
And
Australia, that's Sydney, Melbourne typically moves
exactly.
first, and
Yeah,
Adelaide, Perth, Brisbane really only started to get
exactly.
going from probably from COVID. I'd
Yeah,
say 2019,
yeah.
2020. Yeah.
And conversely, towards the end of the cycle, probably Sydney and Melbourne, at least in general, but there might be sort of
Mm.
pockets, of difference of activity in general, are not doing as well as sort of Perth or Brisbane or other places. And indeed, Perth is probably not doing as well as some suburb outside of Perth.
Yes.
So you get that kind of rippling out effect. I think that is a relatively kind of stable dynamic within the context of the cycle. But ultimately, property is a locational asset, and there'll be local supply and demand factors. There'll be, whatever's going on, inward migration, investment, new infrastructure, um, et cetera, et cetera. And that will determine how well any particular parcel of land or piece or real estate is going to do.
Sure. And I sticking with that theme, I guess, in terms of timing, recognizing that they'll for as much data as you have back through multiple cycles throughout history, it's at present, the US being the largest economy, has been the the property market has peaked first and others have followed. How about the share market? My understanding is the timings are somewhat similar. Would, other
It
than,
can be. It
yeah,
can be.
but not
I
always.
mean, yeah, not always, not always. Well, I mentioned last cycle, so the US peaked in late 2006, but you would
Yes.
say that the stock market went up for at least another year. Um, so there is already that lag, even where the sort of peak of the cycle and the stock market peak were relatively close together.
Mm,
I think they're a bit closer together in the UK because we had a peak in 2007, and then of course markets fell to pieces after October 2007.
Sure.
But the reality is that the US is going to very much influence the direction of global stock market. So there is maybe less of a lag in other countries. But on the other hand, and this is going back very far in history, and you may question whether it's relevant. The 1920s, the
Mm,
US real estate market, as far as we can tell, but of course we don't have, sort of big data sets and so on this. As far as we can tell, the US real estate market peaked around 1926. But there
mm,
was, cutting of interest rates, there were tax incentives, there was the kind of the hype of the Roaring Twenties, and a lot of the money that was in the property market went out into commercial real estate. So all the kind of Manhattan skyscrapers, a lot of them were built in the late 20s. I mean, they were complete speculation. They had no hope of filling those buildings, right? So, but there was sort of incentives to do it. So people did it. This is the kind of madness you get towards the end of the cycle. And of
mm,
course, money capital also flowed into the stock market. And, once you're in a bubbles can go on for quite a long time. And so while the real estate market, the land market was really in not a great shape. I mean, agricultural land was not in great shape for the entire 1920s, and banks had all these sort of extend and pretend situations, but they were making it sort of happen. They were making it work. Residential real estate probably wasn't doing so well after 1926, but commercial real estate was doing better, and and the stock market was disguising a lot of underlying problems. But nonetheless, 1927 and 1928 were very good years to be invested in the stock market. So
mm.
you have to understand the cycle. You have to understand the framework. You have to understand the risks. And I think that this framework gives you a very good sort of understanding of that. But then you have to invest in what is in front of you. And if you're in a
Yes. Yeah.
bull market, my advice would be not to kind of sell everything, but to make sure that you know where you would exit as the markets continue to go up, or make sure you don't over leverage. Make sure you are prepared to miss out on some of the bull
Yeah.
market. Mostly that can be difficult. Isaac Newton was a very famous example of that. He was an investor at the South Sea bubble in 1720, and he actually made quite a lot of money, and he took his profits out of the market when he thought it was at the peak, and of course it should have been the peak because the whole thing was going completely mad. But the market kept going up, and he got FOMO, and he put it all
Oh,
back in again, and he lost quite a lot. So this is not something that you have to be sort of particularly dumb or whatever. I mean, very intelligent people can make this mistake. Fear of missing out is very strong. Um, so you've got to understand that these rare the various dynamics and invest accordingly, and have kind of advisors who can help you do that. So I think you guys are in a good situation.
I think I just want to keep reinforcing that point because you actually answered probably what my next question was going to be around is how should investors be positioning themselves based on the absorption of this knowledge and some of the inferences I take from that. You made a very specific comment there. It's not necessarily particularly property, even more so than shares. It's not necessarily cashing in all your chips and burying cash under the mattress and waiting for it all, the next
Mm.
GFC to come and go. It's
Mm.
it's far it's certainly not as simple as that, and it's certainly not as dramatic as that all the way through. There are
Yeah.
rises and falls along the way. So recognizing that obviously every investor has different time frames, different levels of wealth, different goals for what they're doing with their money. Just some high level principles to would you be able to sort of share as to
Yeah.
how should people be thinking about how they navigate this next sort of 12 to 18 months?
Well, firstly, I would probably think of it as a bit longer than 12 to 18 months, just
Hmm.
because um, we might be well in the middle of it in 12 to 18 months, and the plan that you have going into it should be the plan that you have kind of through it, as it were, if it's a
Yeah.
sound plan, of course. Um, I mean, some of the principles, and I've talked about this with our subscribers, and we'll continue to do that. The first thing is that we've hopefully used the last sort of couple of years as we've sort of seen the cycle start to peak to prepare. So I've told people that it's time to look at your sort of portfolios and decide, are these things I want to keep holding for the long term? If not, and I'm probably thinking in particular about kind of real estate assets. If not, then now is the time to start thinking about getting rid of them. It doesn't mean you're going to be um, it doesn't mean you're going to be selling right at the peak, but you probably want to leave something on the table for the poor bugger who's going to buy it from you, right? It's a good
Yes.
time to be selling. So focus on sort of elevating the quality of your portfolio. Um, we've also suggested to people that if you're generating cash, you might want to keep some of it aside, um, because you want to have optionality. Um, it's we have the sort of idea that we'll sell out closer to the peak and have bank even more cash, but sometimes people will stay in too long. So you might want to think about sort of building some reserves against, both difficult times, but also having optionality when the cycle bottoms and it's starting to turn around, when there are going to be lots of good bargains.
Mm.
And then we've also said to people that we're in a bull market. Um, and it's important that you don't suddenly just kind of sell everything on the basis of a long-term forecast. And
Mm.
so you can manage that in certain ways. You can have stops, you can decide, you can successively move your stops up, and so that you've got that downside protection. I mean, even if it's notional and you've got an idea that if the price hits this level, I'm selling. And you do that on an individual stock basis. You don't do it. I mean, you might have it. You just might be invested in the Australian market or something, but you know what I mean. You probably have a sort of diversified portfolio of assets, and you want to look at those individually. I think. Um, so you're potentially benefiting from upside, but you've got some of the downside protected. I think those are the sorts of things that you can do, and just be mindful that we are getting close to the end, and at the end of
Yeah.
the cycle you usually get a major crisis. The other thing is, I think the most important thing is don't over leverage. So
Yes.
you can't I mean, this is where I think most of the problems arise, is that you've borrowed too much. The bank will come calling, as they always do in a crisis, or assume they will come calling in a crisis. Don't assume that you're so strong that they won't you know won't
Yeah, well,
renege
I
on
mean, in
certain
Australia
things.
last time around, they had perfectly sound borrowers have their loans called in.
Yeah,
So they could
exactly.
comfortably service the loan on their property, and then they were forced to sell that asset.
Yeah,
I think it might have been Bankwest when it got taken over by CBA. They were
yeah,
essentially forced to sell an asset that they didn't need to. So I totally agree, and it's something that I think the other element to that context, Akhil, is your employment situation. I think it's very different from a government paid school teacher to someone running their own small business that has more, I guess, um, what's the best way to put it? Uh, More risk in their income source. Would also influence the appropriate level of leverage person to person.
yeah. I mean, the rule is you must not be forced to sell during the
Yeah.
crisis. Yeah. So you can ride out the crisis well enough if you hold on. I mean, there's some investments that are going to be totally kind of effectively deleted by a crisis. You might have bought a property in some area where basically the area, it was never an area that people want to live, but there was a kind of a fiction because there was a lot of speculation an
Mm,
idea that a lot of people will move there. So those will never come back. But in general, if you're investing in quality assets and you've got good stock portfolio, you can survive. Um, but if you're forced to sell in the middle of it, you are going to be selling at the worst possible time. You'll be a forced seller. There'll be
yeah.
very few buyers. You won't get a good price, and you will be forced to sell all the quality stuff. and that can take forever to recover from. I mean, it takes a long time.
Yeah.
So you do, and the route to kind of getting to that situation is leverage,
Understood.
borrowing to invest.
So I can just see in the sort of corner of the screen there's a few audience questions coming through. Just before we get to them, just an opportunity for you to talk your book, not just your book, but also your research service, property share market economics. Yeah, to sort of share with the audience how you help in I guess in the broad themes of this workshop today. How do you help investors prepare for the end of the cycle, and obviously how to take advantage of the opportunities that are likely to come on the way back out?
Yeah, so thanks for that. So, along with my business partner Phil Anderson, we run what's called property share markets economics, and we provide regular commentary on lots of different markets and on the progress of the cycle. We provide stock market and commodity forecasts, roadmap for the year ahead. That gives people I think, a relatively good sort of idea of what the stock market is going to do over the next 12 months. I mean, principally around the US, but since most markets follow what the US is doing, it's good for other markets as well. Um, and we also give them some ideas on, things they might want to be looking to invest in. We have a sort of we're obviously not an advisory business, but we have a sort of model portfolio and things like that nature. So to give people ideas and also the confidence to understand where they are in the cycle and sort of ideas on what they should do about it. There's several different levels of memberships, and one of them is a free newsletter which comes out weekly, so people can kind of get a sense of what the cycle is like and what it's doing, and how the news kind of relates to it on a weekly basis. So just go to our website, propertysharemarketeconomics.com, to sign up for that. Um, just a quick plug on my book. So you mentioned at the beginning, I'm the author of The Secret Wealth Advantage: How You Can Profit from the Economy's Hidden Cycle. So that book is essentially a practical guide to the cycle. I take the reader through a journey through the cycle. Um, I illustrate each stage with different episodes from history, and also the kind of most recent cycle as well. Um, in between each of those sort of chapters on a successive stage of the cycle, I also kind of explain why the cycle happens, how it's linked to the land market, why no one sees it, how the sort of how economics as a discipline got changed effectively to describe the cycle, how money and banking fit into the whole thing, and various other sort of topics like that. So by the end of it, you should sort of hopefully sort of relatively fully and actually fairly good detail as well understand the cycle and how it plays out, and why it happens and why no one sees it. And in addition to all of that, at the end of each chapter, I give people some practical kind of guidance on the sorts of
I
things they might want to be doing at that
I
stage in the cycle. So it's both kind of explanatory and predictive, and
very
also
big fan
practical.
of those practical those practical elements you got in the book, Akhil, having read it myself. And just to give you an example of how we incorporate your research and both the book and the research is, to give some recent examples, is we launched our strategies back in July 2023, um, at a time when there was almost an absolute consensus the US was going into recession from sort of mainstream economics, and your research helped us sort of maintain the confidence that we were way too early for sort of the expectations of a major economic downturn coming, and that gave us the confidence to stay fully invested and in fact overweight growth across the different strategies. But also on the back of that, what you've talked about, what to expect in the years to come, it also gives us caution to go more defensive in these portfolio strategies than maybe the index options would. So it's been really valuable research that we've incorporated into our approach, and it also sort of influences the broader plans that we lay out for our clients.
Brilliant.
All right, so some really valuable insights. Really appreciate you sharing them, Akhil, and giving us your time. We do have some time now for questions. I can see a couple have already rolled in, so I'll read them out. But if anyone also, if you wish to sort of come off mute and ask, by all means. Otherwise, drop your questions in the chat. So just starting with, sorry, I just lost it. Where did it go? Just starting with, so Martin's got a question. Hi, Martin. Martin's a client of ours, invested in our strategies that draw on this research. So, is there any historical precedent on the limitations of property market affordability that is being seen in countries? And as such, the current market is becoming more investor-led, less owner-occupiers, and what are the new opportunities for investors in this landscape? And I sense opportunity may not necessarily be how you frame your answer.
Hmm. So, I mean, it's a good question. Affordability, I think, is a perennial issue every cycle. So, it's hard to think about it now, but in 1998, there was an article about how unaffordable London property was becoming, and this was, I promise you now, compared to where things are today, it seems incredibly affordable. So some of this is it's a perennial concern. Property is always too expensive, and there are various sort of barriers in the marketplace to
Mm.
kind of somehow, quote unquote, manage this. Often it's done by the bank saying they will only lend a certain multiple of income, but also it's done sometimes on the basis of central bank regulation or something like that. So I think the precedent is there. Now, there must come a point at which it simply can't be afforded. The problem with that is, of course, that what we think is unaffordable is not nearly as unaffordable in sort of, say, China, where kind of property prices as a percentage of or as a multiple of median wages is much more significant than it is in Western countries. So there's no kind of absolute level that you can point to. I appreciate this is probably not answering all of your questions. So in terms of where things go, I think what will happen in the property market, if I were a betting man over the next cycle, is there will be a lot less investment for capital gain and a lot more investment for long-term income.
Is it because of
And so,
the entry costs are so high now for the new investor? Is that part
yeah,
of
I
it?
think I think partly that, but I think it's the asset. I think property as an asset class is probably changing quite significantly. You've got
Mm.
a lot of, I don't know if this is the case in Australia, and I do apologize for not knowing the detail, but in the
That's okay.
UK, a lot of very large institutional investors are now acquiring enormous property portfolios,
Yeah,
and
we
they're clearly
do.
seeing that as you're
Yeah, we
seeing that
have
as well.
started to see build to rent happen in
Yeah,
Australia. Blackstone and a few others are starting to do that, and
yeah.
probably the other theme that I've heard you talk about it as to how property may change over time as an asset class is fractional ownership through things like
Yeah.
tokenization and whatnot with some of that new technology emerging.
Yeah. Okay. So, I mean, that's a good point. So, I mean, just back to the overall point. I think the scale of property investment will probably go up, at least in kind of major cities and other things. I think the sort of the day of, and I'm now very much sort of coloured by what's going on in the UK. But I think this is a trend in the US, in Australia as well. I think that you'll see that the scale goes up. It's about sort of long-term income streams rather than capital gains, and sort of this sort of that sort of model is probably here to stay, and so that will drive a lot of smaller investors out of the market because they won't be able to. They don't have deep pockets and long-term horizons in the same way. What other opportunities are there? I mean, I get the sense that we're only getting started at how reimagining work and how cities are laid out and so on. So I think a lot of the opportunities will probably be more in the commercial space,
Mm.
because and we're only beginning to see the changes as a result of new working patterns. And then there's going to be all this other stuff around. self-driving cars, and this is going to just fundamentally shape how people interact with the sort of landscape and where businesses then set up and the type of businesses that they, the type of layouts that they'll need. So I think there'll be a lot of property opportunities won't necessarily be all in the same kind of domain. But maybe I'm wrong. Maybe some of these larger players will only kind of want, uh, you know, um, kind of houses or something because people who are renting houses don't move as often, whereas people in apartments are in and out all the time. So I don't have a clear answer, but those are some of the considerations. The
I,
fractional ownership point, I think, is a
mm.
good one. So
But
maybe some of the
just before you quickly address that, Akhil, I just want to add my 2 cents for Martin's benefit and the audience in general. I think this is kind of where I feel like we're unique as a financial planning business relative to others that may be recommending a property investment strategy as part of some overall strategy mix for our clients is that and not every one of our clients sort of absorbs this particular research methodology, but for those that do have an interest in it, and that's part of the purpose why I've put this workshop on to introduce it to our broader client base, is it gives us the opportunity not to just implement a property investment strategy as and when you've got the capacity to do so. It allows us to draw upon a research that allows us to look at times in the cycle where you might be in a position financially to be able to facilitate a transaction, but it might not make sense to execute on that from a cycles perspective. And some it's a non-linear way to execute the plan, if that makes sense, Martin. But we can certainly talk more about that offline as to how that may apply to yours and Pauline's situation. But sorry, Akhil, you were going to talk about fractional ownership.
well, I mean, I don't know too much about it other than I can kind of see this as a vehicle for enormous speculation at some point in the future. But as things get more and more expensive, but as you get sort of the blockchain and kind of the secure kind of records and so on, people can own parts of Monaco apartment or Sydney high
Mm,
rise or whatever. And maybe one day there'll be a sort of a stock exchange where you can buy and sell bits and pieces of these things. And that would be that would introduce a lot of liquidity into the system. It would no doubt drive prices higher, but also enable people to make sort of money out of property investing in that way. And there'd be
Probably
lots
make
of
it more
sorts.
volatile too, I'd imagine.
Well, yeah, absolutely would make it more volatile. It would also, probably bring a lot of new investment into the market. So it
Yes,
would, and so if you're looking to exit um, your property developments or whatever, this might be a way to do it. So
absolutely.
anyway, it remains to be seen. All sorts of possibilities. Be all sorts of different kind of financial services and business around
Mm.
that in time. We're talking quite long term potentially, but nonetheless, it's something to
Probably
watch out.
more for next cycle. So
Yeah.
we've got another question from Andrew Warren. Andrew Warren's a client of ours and investor in the portfolios. He's also a subscriber. Port Phillip. Pardon the
See.
Freudian slip
Yeah.
there. Property share market economics.
Yeah.
And he's read your book a number of times. So
Very good.
yeah. So Andrew, he's very keen. He's actually also a very keen investor himself. So Andrew would like to understand the your question is, so would you mind sharing your view on how the end of the cycle's economic canaries in the coal mine, so to speak, how are they currently tracking?
Right. Okay. I
I
mean,
guess and
some
if
of
I could speak for Andrew, please, Andrew, jump on chat or whatnot if you want to give further context. But maybe an example of the last cycle is Iceland or subprime mortgages were just these random things that happened that were explained away as not big deals, but when you looked back, they were the first signs that there was a broader economic slowdown coming. Perhaps I think that's the context that Andrew's come
yeah.
speaking of, and it's like,
Well,
where is
you've
that
you've
at
got
now?
you've got sort of some of the frivolous things like world's tallest building or longest building, and kind of slightly crazy investments like a ski resort in the desert. And if I'm not mistaken, last week there was for modern work of art, the second
Yes.
highest ever price
Yeah,
at
it's double.
auction.
Yeah.
Um, so you've got all that kind of stuff. We've got UK's second tallest building in Manchester, which is, it's a big city, but it's nothing like the size of London and so on. So you've got those signs. You've got a lot of people talk. I mean, and this kind of slightly not doesn't worry me, but I'm sort of interested in this. A lot of people talking about potential risks in the sort of private credit market and private equity space. So if everyone's talking about it, makes me think that's probably not the canary in the
Mm.
coal mine, it's something else.
Well, John
Um,
McKenzie's just dropped a comment in the chat that I think is worth mentioning in this regard is would the REITs, for example, or or James Hardy shares and the sort of recent performance in that, would they be examples of warning sign? I think there's probably
yeah,
another to expand upon that. You've written in some of your research updates the US Home Builders Index as a sort of leading indicator of what may be coming more broadly for economies.
yeah, exactly. I mean, I mean, that's exactly right. So the insight is, and I write about this in my book, that home builders peak before the stock market, and this is very linked to the cycle because investors in those stocks don't see any future growth in earnings to justify a continued rise in prices and so on. And so the stock is bid down. People are rotating money into other areas of the stock market.
Mm,
And it's important for us because we know that when you see a slowdown this deep into the cycle, that is potentially sort of a big warning sign. So we had quite a big sell-off from last year into this year. We actually had quite a significant rally in some of those stocks, US stocks that we're looking at, like Toll Brothers and so on. I mean, 50, 60% up. I think some of them were. Um, and they have fallen quite hard again. So clearly looking at that as a warning sign. Um, I do. You mentioned earlier, sort of, we've got the age of Trump and so on. And this might be a complicating factor because he's a real estate guy. One thing he understands is kind of, property prices going up and so on and pushing bank credit into the market. And so he's been announcing things like the 50-year mortgage and so on.
mm,
And there's a lot of pressure to reduce interest rates, short-term interest rates. The US government is clearly trying to manipulate the US bond market, push yields down, and so on. And this might, just be one of the things that, keeps the party going a bit longer than we might expect, or at least, on the surface of it, it's looking like the market, the party's going on a bit longer, but it's all falling apart beneath the surface. But as an investor, you
mm,
you kind of have to kind of just invest in the market as it is. So there are signs. Whether anything has given me what I regard as the bell at the top, I don't think so, not yet anyway. But there are certainly many
yeah.
signs. But there've been many signs for a bit of time now. You have a situation now where some economic data looks really good, and some looks really quite puzzling. So you're seeing rise in foreclosures and loans in arrears and other things like that. Um, we have a very narrow kind of US market in the sense that most of the growth is from a handful of companies in one or two sectors, and are quite vulnerable to that, partly because there's all sorts of shenanigans going on in the AI space. Nvidia investing in a company that's buying its chips and all this sort of thing. So it's all looking a bit worrying. The thing is, it
Mm.
can go on for a bit longer than we think is possible. So
Was it Alan Greenberg that spoke about irrational exuberance in, I think it was 1996, and markets in the dot-com bubble didn't peak until 1999. It, it it's
indeed,
it can, yeah, the market can stay irrational longer than you can stay solvent, so to speak.
yeah, yeah,
I
yeah.
think it's just, yeah, it was, yeah. I saw it on your fund manager update recently that the notion of really it's about walking the tightrope at the moment as to there is some probability, an increasing probability of a market peak, but that's not a 100% probability at a specific point in time. I think that's the key, really key takeaway as to how you manage, you navigate the coming years is that it's being approximately right rather than precisely wrong, so to speak.
Yeah,
To borrow a Warren Buffett quote. Um, Thank you very much, Akhil. That's all the time we've got for right now for questions. Want to sort of segue now into talking about how we draw upon your research and utilize that into our asset allocation approach for clients. There will be another opportunity at the end if anyone's got any questions. So by all means, Akhil, feel free to hang around. But I really thank you very much for the time that you've shared with us.
brilliant. Okay, thanks so much.
Pleasure. So just want to start by discussing the three main portfolio construction styles that we offer at Life First Advice: index, core satellite, and active. So a pure index approach seeks to give you the return of the index at the lowest possible cost. So unlike active management that's seeking to outperform the index over time, a purely index approach is essentially the middle ground in what you can expect in terms of performance. There's very minimal manager risk as the manager is there purely to construct a portfolio that replicates the index. So your real risk lies with the performance of the index itself, not the manager's selection of investments. And then jumping to the right of the slide, the active approach is seeking to outperform a chosen market. For an example, an Australian shares fund manager would typically be seeking to outperform the ASX 200 or 300, for example. Active management provides for the potential to outperform a chosen index, and by default, this also means there are risks that it can underperform. Typically, active management comes with higher costs due to the greater research requirements in identifying those opportunities to outperform. But it also comes with a greater degree of manager risk in that you are reliant on the specific manager you've selected to perform better than the equivalent index option to justify those higher costs. So now turning to the middle, which is core satellite. So a core satellite approach aims to achieve the best of both worlds, combining an index approach at the core and taking a more active approach with the satellite positions of the portfolio. So think of the core as the sun and the satellite as the planets orbiting around the core. So the core stays relatively stable through the cycle, typically invested in a pure index strategy or something closely reflecting an index approach. Although some of the investors in our strategies will have seen in our most recent update is that we've essentially moved you down one rung in the index strategy. So those in growth are now the core is invested in the balanced portfolio to increase the defensive exposure of the overall portfolio. That's deliberate. And then the aim of the core is to minimize cost and transactions. The satellite is more active component of the portfolio, and there's a range of different ways a satellite portfolio can be put together, but in general, it's the more active part of the portfolio. Excuse me. So we offer three strategy options to consider. One being index. That's for those that want essentially a simple, low-cost solution, obviously agnostic to the research presented by Akhil today. For both of our core satellite options, we've partnered with BlackRock's enhanced strategic models to act as the core for these strategies. For core satellite passive, the satellites are low-cost ETFs or exchange-traded funds, reflecting the themes drawn from the market cycles research, such as that presented by Akhil tonight. Examples of some of these themes at the moment, and if you've read Akhil's book, these themes are well represented as opportunities at this stage of the cycle, being markets such as emerging markets, commodities, and smaller companies. So all those themes are currently well represented in our strategies. Core satellite active. So this portfolio is similar to the previous. However, it also includes active fund managers with a long-term track record of performance in their respective theme. And so for all three strategy options, they're available across all the four main risk profiles that you would be familiar with in superannuation and the like, them being conservative, balanced, growth, and high growth. And the strategies are accessible both inside and outside of super. So we've been running them now for a bit over 2.5 years. So it's still pretty early days, but pleasing to see that they're doing the job they're designed to do. They're currently, both of the strategies are significantly outperforming their respective indexes. And so, a lot of thanks to Akhil and his research and in the input that's sort of helped us achieve those results. And as you've heard from Akhil, we do expect in the coming year or so to be heading towards a major global downturn. And unlike the index option, the core satellite strategies we manage for you all have the capacity to go quite defensive in the anticipation of this downturn. And as I mentioned earlier, in our most recent update, that's exactly what we've started to do. So that's all I kind of wanted to share today. We do have some time left for questions, but in the meantime, I'll now hand you over to my colleague Adil. He's going to walk you through essentially how you can take practical action on what you've learned today and apply it to your own investing. Over to you, Adil.
Thank you, Dane, and thank you everyone for joining us for this evening again. We thought we might just leave you with some key takeaways from the conversation we've had today. And as you can see on the slide, maybe the first key message we want to leave you with is that history never really repeats, but it does rhyme. So every time people say this time it's different, do remember this, that there is a bit of a rhythm to how human behavior has been over the decades. A lot of people do focus when it comes to the investing on trying to pick the right stock or trying to pick the right fund or the fund manager. However, I think in our belief and what you may have heard from the conversation is that what is going to influence the biggest outcome of your investing outcomes is going to be your risk profile. So by that we mean whether you kind of you adopt a growth style, a conservative style, a balanced style, and the asset allocation decisions which flow from there. And as we've heard today again from Akhil and Dane, that asset allocation during volatile times becomes really important to influence your long-term investing outcomes. Probably all of us can agree that we live today in what is called a VUCA world, which is volatile, uncertain, complex, and ambiguous. And in this sort of a world, we feel that the best thing as investors you can do is to control what you can, which is your mindset, your behavior, and your actions. You can't control what others are doing, but you can kind of take advantage of research, which we discussed. You can kind of look at research which you would like to follow and control that as to how you kind of respond to being in this world, which is quite volatile, uncertain, complex, and ambiguous. A few other things to leave you with is that we believe strongly, and as you can imagine, as financial planners, we strongly believe that if you were to kind of undertake some sort of planning that puts you in a position to succeed or take advantage of opportunities as they come up. So if you're well positioned with proper advice, either from us or from anybody licensed financial advisors, we can put you in a sort of position to succeed and take advantage when the market cycles do turn, all at that particular time. And then finally, to leave you with one sort of a very philosophical quote, we always say to our clients, like, aim to be less wrong with your life and your money decisions. And essentially, you will never get everything right. But if you can be less wrong, take the next step, aim for progress over perfection, because you'll not be able to time everything perfectly in your life or when it comes to your investing.
From my perspective, I see that as the most important takeaway of all of them.
So hopefully this has kind of been an educative and information sort of evening for all of you. If you would like to take action on what we've discussed today, you're more than welcome to book in a free strategy session with us. Quite a few on the call are already our clients. We do have these conversations with you regularly, but for those of you who are new to us, we will put the link in the chat to be able to book a strategy session either with me or Dane. And you can also follow us on LinkedIn, Facebook, YouTube, social media of your choice, or kind of email us. And we are more than happy to set up some time with you.